Howdy everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Regeneron. As per one of my subscribers in the comment section in the last video, Altape said, "Hey, nice video, could you please analyze Regeneron Pharmaceuticals, an interesting company in my opinion." So with that said, let's analyze this company and take a look at their fundamentals, compare it to the share price, and come up with a target share price based on their free cash flow and the shares outstanding that we think that they're going to have within the next 4 years. So with that said, let's get started with this analysis. We are going to jump right into the ticker symbol, guys. Regeneron, ticker symbol of REGN, market cap of $72.6 billion, PE, guys, of 9.18. I was actually fairly surprised by this because the first thing that I saw when I went into Seeking Alpha, it was a $660 share price, and I was like, oh my god, this PE must be off the charts. It actually isn't. So based off of their earnings, this actually might be a fairly accurate price to pay for this company. However, we're going to take a look at other metrics to come up with an even more accurate representation, like always. They do not pay a dividend, which actually means that their 5-year average free cash flow is going right into themselves to pay down their debt and to even make acquisitions in the future. Taking a look now at their fundamentals, starting with net income 5 years ago of almost $1.2 billion to 1 year ago of, oh my god, $8.1 billion. That is an increase of 574%. Now, Regeneron, if I am not mistaken, this was the company that made the medicine Regeneron that was actually fairly good at treating COVID, if I'm not mistaken. And seeing that 1 year ago, of course, was 2021, and I'm fairly certain this is when a lot of states began to actually allow this drug to be used for treating COVID to people that had it. I'm pretty sure this is the reason why it just skyrocketed as of 1 year ago, and I'm pretty sure that as of 2020, they also pretty much just got started with their whole entire popularity. So I think that's the reason why these two numbers are very off the charts as compared to 5 years ago, where they only did 1.2 billion, 4 years ago they did 2.4 billion, and 3 years ago they actually went down to $2.1 billion. Looking now at the free cash flow, the lifeblood of the company. Guys, this is cash from operations less your capital expenditures. 5 years ago of $1 billion to 1 year ago of $6.5 billion. This is an increase of 531%. Again, that's a massive increase, with a 5-year average free cash flow of $2.7 billion. And we see the same thing that we just saw with the net income, kind of, right? Normally the net income 2 years ago was significantly higher. However, we still see the same reaction happen 1 year ago, where they just went from $2 billion 2 years ago to a whopping $6.5 billion the next year. I think this has to do again with the fact that a lot of states here, at least in the US, they were actually allowing Regeneron to be used to treat COVID. Now looking at the revenue 5 years ago of $5.8 billion, or around $5.9 billion, all the way up to, look at this, oh dear lord, $16.1 billion. That is an increase, guys, of 173.7%. Oh dear lord, just absolutely amazing. This company is actually looking fairly good. Now, they do not have consistent growth when it comes to their revenue. As you can see right here, 5 years ago to 4 years ago, they did go down. But nonetheless, it's not like they went negative or they went down like a significant amount. It was only a couple $1 million, right? We see the same thing when it comes to the free cash flow, right? And of course, we see the same thing when it comes to their net income. But nonetheless, I honestly do believe that this isn't that bad as a revenue, free cash flow, and net income figures. It's actually looking really solid. Coming now to the total assets minus the total liabilities. If they were to liquidate all of their assets, would they be able to cover their liabilities, and how much money would they have left? Well, if they were to do this, they would have about $18.8 billion left currently. And for their credit too, guys, ever since within the past 5 years, they have been above water every single time. Now, 2 years ago, they did go down slightly from their 3 years ago, but nonetheless, they're still very solid when it comes to covering their liabilities. Average total assets around 17.2 billion, average total liabilities around 4.8 billion, average assets minus the average liabilities, we get around $12.4 billion. Now looking at the shares outstanding, the metric that I actually feared to look at because so far everything has been doing great. This is usually where companies tend to falter, but you tend to be a little bit weary, especially when you get to this one, because since they do not pay a dividend, they can actually just justify to just issue shares, right? But it's actually not looking too bad, kind of. 5 years ago of 107.5 million shares, to today, guys, of 106.6 million shares. On the 5 years, this is a decrease of 0.84%, which is really, really good. However, take a look at this. From the previous year to the current year, they did increase it by around 2.5%. So we're looking at now, 2 years ago to 1 year ago, they did increase it from 104 to 106.6. So as it stands, they might issue a little bit more maybe into the future. I don't know, right? I don't know if they have declared any share buyback program or anything like that. So this is something to take into account when I make my assumptions. But nonetheless, within the past 5 years, they have decreased it. And lastly, when it comes to their cash and equivalents, they're currently at $2.9 billion with an average cash around $2 billion. Time to make some assumptions, low, medium, high, using 3 different factors: revenue growth, predicted share buyback, and the required rate of return. Revenue growth, guys, I like to use Seeking Alpha's growth tab, and for this one, it was again very, very difficult, mainly because the revenue growth year over year and the revenue growth forward, it is very, very different, right? We got the revenue growth year over year at 89.14, but the forward is only 13.51. So I have to be conservative when it comes to this. I'm not going to go anywhere near like even a 20% number. The highest I'll go is 16% because I want to be conservative. Now, for the predicted share buyback, I'm going to be using the shares outstanding graph that we just saw. And for the required rate of return, I like to keep it the same, flat 10% to match the S&P 500. So, for my lowest assumption, let's say a growth of 10%, predicted share buyback of -1%. The reason why I'm saying this is because they have issued 2.5% of shares from 2 years ago to 1 year ago. So I'm going to take the worst case scenario and say that they're going to continue to issue shares at -1% within the next 4 years. Now, doing this gives us a target share price, not adjusting for debt, of $794.73. For my media assumption, we get a revenue growth of 13%, and let's say that they don't buy back any shares and that they don't issue any shares. This is $886 flat. And for my highest assumption, let's assume a revenue growth of 16%, predicted share buyback of 1%. This comes out to be $985.68. Now, adjusting for debt, this is why we take a look at the cash and equivalents. So we take their cash and equivalents and we add that to the net debt. If they have more debt than cash, this number comes down, and if they have more cash than debt, then this number comes up. As you can see, it comes up almost a lot, like almost $1,000, which is just insane, right? This means that they have a lot more cash on hand than they have net debt, which is really good. So for my lowest assumption, this is now a target share price of $1,616.26. For my median assumption, it is almost $1,800, and for my high assumption, it is almost $2,000 at $1,999.69, which is just insane. Now, let's add the margin of safety just because we don't want to overpay for something. The more you pay for something today, the less returns you're going to have in the future. It just makes sense, right? So let's add the margin of safety, 5, 10, and 15% to this target share price after debt. And I personally would like to buy this between $1,374 all the way up to $1,535.45 for the low assumption. For the median assumption, it is between around $1,529 all the way up to $1,709. And from highest assumption, it is between $1,700 all the way up to, well, $1,900, right? I'm rounding up or rounding down in regards to these assumptions. So as you can clearly see, guys, the share price currently is 660. If you believe my assumptions, right? If you believe these growth assumptions, the predicted share buyback, and if you like my required rate of return, then this is an absolute buy right now. And seeing that my median assumption, it still has the highest number of $1,799, right? That is huge. That is massive gains of more than $1,000, which is just insane, right? So as it stands, if you believe these numbers, then this is an absolute buy right now, right? As it is. And this pretty much shows us that the PE might actually be in the correct area as well, because the PE is only 9, right? So this is actually might be looking like a really good stock to buy right now. However, This is not financial advice, guys. It never is. I'm just showing you guys the raw numbers when it comes to the fundamentals. It is public information. Anybody can see it. I use Seeking Alpha. You guys can use Yahoo Finance, right? It really doesn't matter. And when it comes to these assumptions, I'm just showing you guys my assumptions. I'm not telling you guys what to buy. I'm not telling you guys that these are the numbers that you should follow, because if you just change any of these revenue growths or the projected share buybacks or even the required rate of return, all these numbers would change drastically, right? For example, let's just say that, like, for my lowest assumption, you don't believe that this is going to grow at 10%. You only believe this is going to grow at 2%, right? Because COVID's dying down, right? The fear of COVID's dying down and all this stuff. So let's just say that you only think that they're going to grow at 2% and that they're going to continue to issue shares, but a massive share dilution at -5 shares. And let's say that you want a higher required rate of return, let's say 12.5%. Well, now as you can see, the target share prices have dropped significantly. Now the target share price not adjusting for debt is 435, and the target share price adjusting for debt is around 897. So it really just depends as to what your assumptions are. That's why I have this calculator, guys, available for free. Any one of you guys can have it. I have an entire playlist of calculators that's just called calculators, where I show you guys how to use this one, the book value one, and a dividend tracking sheet. If you would like to have these, guys, all I'm asking for in return is like, subscribe, comment. Thank you so much. We got a massive surplus of subscribers the other day because of my check video. Thank you very much. Oh my god, I was not expecting that at all. But then again, check did move like 30%, which is insane. But nonetheless, all I'm asking for in return for these 2 free calculators, and I'm working on a REIT one and a dividend tracking sheet, all I'm asking for in return is like, subscribe, comment. Just help my channel grow. That's all I'm asking for, right? I would love to reach 1,000 subscribers by the end of the year. That would be so awesome. And if we keep going at the rate that we're going with the check video, we could get that before the end of the year very easily. All in all, guys, when it comes to Regeneron, I was not expecting this. When I saw this, I'm like, nah, this is not going to be good, right? I foresaw this, the share price. I'm like, this is the PE is probably like 50, right? And well, after doing this analysis, I was fairly surprised by this. They have a lot of good numbers, like no joke. The only issue that I guess I'm kind of having, it's not even an issue. It's more of just like, I gotta keep an eye on this, and I suggest everybody keeps an eye on this too. If you're interested in this, is keep an eye on those shares outstanding, because if they issue a lot of shares, personally, anything above 5% within the next like 4 to 5 years, that's a little bit of a red flag, right? And they can't do this because they're not beholden to any dividend payments. So yeah, it really is no flack on them. So if you guys are interested in this, just watch that one specifically, obviously. But as it stands for me, really good company. Not even gonna lie, I was not expecting this, fairly surprised. However, I'm personally not gonna buy them because it doesn't fall in line with my dividend strategy. Maybe if I start a growth portfolio, this one is an absolute gold mine. I'm not even joking on this. That pretty much does it for this video. Like if you like, comment, subscribe, as I just said. You guys can follow me on my new tech sites at BitChute, Odyssey, and Rumble. I also have a Let's Play channel, link in the description below. I'm not going to be able to upload on my Let's Play channel, I don't think this week, because, well, I kind of got stuck in the game. I need to collect a lot more of an item that I just don't have, so sorry if you guys are watching this and also watch that. Yeah, probably won't upload this whole entire week when it comes to that, but you know, that's beside the point. If you guys want to see my Let's Play on Sonic Unleashed and other ones as well, you guys can follow me on my Let's Play channel too. And with that said, peace out, and be on the lookout for the next stock analysis of video.